Welcome to Best 1031 Online, where you will get expert insights into all aspects of tax-deferred 1031 exchange from some of the nation's most well-known commercial real estate professionals, as well as CPAs, accommodators, wealth managers, and others. Here's your host, 1031 Broker James.
Let me tell you something. If you're a practicing commercial real estate broker trying to keep up in today's market, you cannot do it all yourself. I couldn't do what I do without my virtual assistant from CRE Task Wizard. Their VAs are trained specifically for commercial real estate administrative work, which frees me up to focus on revenue-producing activities. If you want your time back and your sanity back, go to CRETaskWizard.com. Tell them 1031 Broker James sent you, and they'll waive your onboarding fee. CRE Task Wizard. Buy your time back.
Hello, and welcome back to Best 1031 Online. I am 1031 Broker James, and this is my first episode of a new series that I'm launching called CPA Chat. I don't know how many episodes a month I'll be doing this, probably at least 2 a month, but this is the first one. And joining me today is a good friend of mine, Scott Gilmore, who is the managing partner of Ascend, a local CPA firm here in LA County. Scott, welcome to Best 1031 Online.
Hey, pleasure to be here, James. Thanks for having me and looking forward to educating our guys on all the things 1031 associated.
Awesome. Thank you very much. Today, we're going to talk about depreciation recapture. It's something that happens when people sell a building. So obviously, if you have an investment property, you have the tax benefit of depreciating it each year. Obviously, with residential investment, that's 27 and a half years. With commercial, it's 39 and a half years. And a lot of my clients have owned their property for more than 20, 25 years. So this conversation comes up a lot. So let's start with just briefly explain what depreciation recapture is in layman's terms.
You got it. So depreciation in general can be both a blessing and a curse depending on where you want to look at it, right? The beauty of real estate is you can depreciate it. You can take a deduction every year. It doesn't cost you money. It's really in the basis of what you purchased. But the issue becomes when you sell a building, there is a particular tax rate that applies, and it's 25%, and that applies to the amount of depreciation you took during the time that you own that building. So when you sell that building, your actual tax impact is made up of a couple different rates and a couple different types of tax. And so the calculation is hard to do back of the napkin. It's hard to do in your head. And you really need to go through and look at how much depreciation you've taken and what that's going to mean for your tax hit when you sell.
Right. So why is this so often overlooked by investors?
I think oftentimes when you hear about selling an asset, a building in particular, you think, oh, it's a cap gain. And that's true. It is a capital gain. But 1250 recapture, which is the main type of recapture we deal with, is a subset of capital gain. And so most people, when they think, oh, I have a capital gain, don't stop to think, wait a minute, part of that belongs to the depreciation recapture element, and part of it is a true capital gain, which means the rates you're paying on each are different.
Right. And how does that depreciation recapture differ from the capital gains tax?
Yeah, so you go ahead, you own a building, you have it. We'll go through an example later to get a little bit more granular and be specific about this. But depreciation recapture is a 25% tax. Capital gains have two tax tiers, a 15% tier and a 20% tier. And what happens is you get into the 20% tier at a certain income level. I don't recall what it is right now for this year, but it's been around $600,000 for a married filing joint couple. And so you're either going to pay 15% or 20% on your capital gain piece. But before you get to the share that's taxed at capital gains rates, you have to first recapture at 25% tax the amount of depreciation you've taken during the time you own that property.
Right. And also, too, this comes up, and this will be a great topic for another episode, but a lot of people don't realize they hear capital gains tax and they just think the federal. The rates you just quoted were federal. what a lot of people forget is
That's
that
correct.
the state also has a capital gains tax rate.
The state actually, especially here in California, which is the one that I know the best, there's one rate for pretty much everything in the state. So whether you have ordinary income, recapture, or capital gains, it's all taxed at the same rate. If you're over $1 million, it's going to be 13.3%, for example.
$1 million income?
Yeah. So if you have $1 million of income in California, the rate you're going to pay on the entire gain, there's no segmenting between recapture, capital, ordinary. It's going to be 13.3% is going to be your rate if you have a gain over $1 million. That's just for California.
Got it. Okay. So here's the example we were going to run. This typically categorizes the situation with most of my clients. Like I said, they've owned the property for 20, 25 years or more. They bought it obviously at a great price.
Of course.
And now they want to sell it. And obviously in California, it's appreciated significantly. So in this case, an investor buys a 25,000 square foot multi-tenant industrial building for $1,550,000 in 2008. I should say $1,550,000 in 2008.
Good timing.
Yeah, right. Yeah, I figured it's a little over about 60, almost $70 a foot. He sells it this year for $4.3 million, a capital gain of 2.75. They've taken the standard depreciation each year for the last 16 and a half years. And in my experience, money investors don't realize that whatever that aggregate sum of that depreciation is also gets taxed. We talked about that rate. So walk us through.
So for purposes of this example, I'm going to assume the whole $1,550,000 gets allocated to building for simplicity purposes. Usually when you buy a property, you bifurcate the purchase price between land and building. Land is not subject to depreciation, not subject to recapture. It stays at the same basis as what you paid for it. The building is the piece that you depreciate. For this purpose, let's just assume the entire 550 is allocated to the building. So you depreciate it over a 39-year period. So doing the math, $1,550,000 divided by 39 years, you have about $39,000 of depreciation per year. Multiply that by 16 years for simplicity, it's about $635,000 of depreciation. So you have a building, you sold it for $4.3 million, okay? Your gain, just using the math, of 4.3 less than $1,550,000 gives you a gain of $2.75 million. Here's the caveat. That $2.75 million has two elements of taxation to it. First element is the depreciation recapture that we keep talking about. And so based on our simple math, it's about $635,000 during the time that you own the property. So of the $2.75 million, the first $635,000, you're going to pay a 25% federal rate on it. California, let's just call it 10% for simplicity. So you have 25% Fed, 10% California, 35% tax on the first $635,000 of your $2.75 million gain. The remaining amount of the gain, right? So it's about roughly 635, about 2.115 million. That's the capital gain piece. So let's assume, because you're going to be over that $600,000 threshold I talked about on the federal, you have a 20% capital gain rate, another 10% California. So that's a 30% gain on that, or 30% tax on that 2.115 million. So to kind of summarize, total gain is 2.75 million. That's the simple math. But of that, you have 635 that's taxed at 35%, federal and state combined.
So that's about 190,000 ish.
Yeah. And the rest, the 2.115 million, is at 30%, 20% federal and 10% California. So the 5% spread we're talking about here.
Yeah, so that's another 600,000. So you're looking at almost 800.
Correct. So effectively, if I take 800 grand over 2.75 million gain, it's an effective rate of around 30%, right? It's going to be somewhere in there. A lion's share of it is still taxed at capital gains rates. but you pay that extra 5% in our example, 20 versus 25 on the depreciation piece.
Right. So obviously if you're going to profit 2.75 million and you decide that you're not going to do a 1031 exchange, then that $800-ish thousand is going to come out of that 2.7. So now you're looking at,
2 million roughly, we'll call it.
1.9,
Million
right?
nine.
Yeah.
Yeah.
Whereas,
Now keep in mind,
go ahead.
if through depreciation you were generating losses on this building and you weren't able to utilize those losses during the time of ownership, when you sell this building, those losses will free up against your gain. So if depreciation oftentimes in real estate generates losses during the time of ownership, and that's what people like, you get cash flow, you don't have to pay tax on it because of depreciation deduction. Those losses that you didn't get a chance to utilize come into fruition when you sell the property. So you got to look at every transaction. It's not always here's the tax rate, but sometimes you've got to look at if you have other attributes of your tax situation, which may be helpful. Just think it's important for people to know.
Right. No, that's a great point. Give an example of what a loss might be.
Yeah, let's just say, you own this building in the example that we're talking about, and your property taxes, insurance, and interest expense are equal to the rent that you're collecting. So you're at a break even in terms of cash flow. But then you have, in our example, that $60,000 of depreciation every year. So every year you have a $60,000 loss that you're generating on your taxes, but you're unable to use it because of other tax rules called the passive activity rules. Over 16 years at 60,000, that's 960,000, 16 years. It's $960,000. That 960 goes against your 2.75 million of gain. All of a sudden your tax hit looks a little prettier. So this is part of the beauty of real estate, and where depreciation either helps you today or helps you down the road. Even though you have to recapture those deductions, the timing can actually line up and you can be in the same boat.
Great. Excellent point. But having that kind of loss for 16 years, that's not typical, right?
It's not typical, right? That's a cash flow neutral property that I'm giving you an example on, where the rent is similar to your carrying costs. Usually you're going to have positive cash flow, and the depreciation might get you back to zero or a $10,000 loss a year. It's not usually depreciation, in this example, 60K, is not going to happen every single year. I was just trying to keep the math simple. But let's say you have a $10,000 loss every year. Well, that's 160 grand you can now use against the gain on sale. And that's a more common place, because if you think about it, I had a loss, but a piece of that loss, 60 grand of it, is depreciation, which is not cash out of your pocket. That's just a paper loss that's helping you from a tax perspective.
Now, the question I was going to ask is, however it calculates out, because obviously, like you said, every case is different. If they do decide to do a 1031 exchange,
right,
they get to defer 100% of all of that, correct?
Yeah. Right. That's right in a nutshell. Right. So what happens is you do a 1031 exchange. Your clients do a lot of them. My clients do a ton of them. It's the beauty of real estate. You can trade up without a tax hit. It's what makes owning real estate and investing in real estate such a beautiful attribute. So what happens is if you do a full 1031, meaning you fully exchange, you reinvest all your proceeds, you replace all your debt, no gain, no boot is coming out. There is no recapture element to it. You don't have to worry about that. What I will tell you is if you do have boot on your 1031, the first amounts of boot go to the recapture amounts. So let's say you took $500,000, $500,000 of depreciation. You do a 1031, but you have $100,000 of boot in this example. Small gain, a little bit of boot. That 100,000 would be subject to recapture because the first 500,000, the amount of depreciation you took, is subject to recapture. So it does impact your boot. But your question on a full exchange, this recapture element doesn't come into play. You get to keep deferring.
Yeah, I'm glad that you made that point, because a lot of my clients, especially clients that own their property free and clear, and there's going to be, more than a couple of $1 million in proceeds after everything is, commissions, closing costs, etc. They'll come to me and they'll say, James, we'd really like to take about keep about $250,000 to pay off some debt or pay off our house or whatever. I tell them, I say, look, if you take that 250,000, I don't know what you're going to get taxed at, but that's considered boot and it is going to get taxed. So you're not going to end up with 250. I tell them use that same 30% number and figure that, they're going to take about 75 grand of that and you're only going to end up with 175,000.
It could be even
What I tell
35%.
them,
They could take 35 grand of it because you have the 25% rate on that plus the 10% state. It may even be a little bit more,
right,
depending. Every situation is different.
correct. My advice, what I tell those people is, look, especially again, if they have no debt to replace, they're not putting any debt on the new property. I tell them, look, let's get the new property, complete the exchange, wait 60, 90 days, and then go take a little cash out. Go put some debt on the property because now that cash you're taking is tax-free.
You are spot on, my friend. That's exactly how you go about doing this. If you're into an exchange and you want to take some money off the table, assuming the debt to value ratios work and some other elements are in play here, you're much better off fully exchanging and then taking the cash out after the exchange is closed and some time has passed. And yes, you have a little bit of a loan payment, but over a 30-year period, it's going to be minimal and the cash is going to be in your hand. And that's exactly how you go about accomplishing that goal.
Right, because 99 times out of 100, the debt service is going to be covered by the income on the
That's
property.
what I see as well. Totally agree with you on that point.
Yeah. So what's the difference between Section 1250 and Section 1245 property in terms of the recapture?
This is important. This is an important thing to think about, especially if people get involved with cost seg. This is where cost seg comes into play. Cost seg takes some 1250 property and turns it into 1245 property. So 1245 in layman's terms means personal property. It's equipment, it's furniture, it's shorter lived assets that are depreciated instead of 39 or 27 and a half years. It's over 5, 7, or 15 years in some cases. And what happens is that recapture that you get on 1245 property is not 25%. It's ordinary income rates. It's the same rate as you took the deduction at. So in an example of a taxpayer that's in the highest bracket, which is 37%, if you sold a building with 1245 property in it, you have 1245 recapture, which is going to come back to you at 37%, not 25%. So it's a big rate spread between ordinary and recapture capital gain.
Right. That's the big thing right now. Obviously, the big, beautiful bill reset that bonus depreciation back to 100%. And I believe they made it.
Yes.
Right?
Yes.
So speaking of cost segregation, how do strategies like cost segregation or bonus depreciation affect recapture exposure?
That's a great question because when you go in to do a cost seg, you have to truly understand this piece of it, right? Some people have heard the saying, there's no free lunch in this world. Well, this is one of those examples where really what you're dealing with is a timing difference. When you go ahead and do a cost seg, you are turning a 39-year depreciation schedule into a component schedule. Some is 5-year depreciation, some is 7, and some's going to be 39. Most of it's going to be 39, but certain elements, because of the cost seg, become 5 and 7-year depreciation schedules. And 5 and 7 years means you get to take 100% bonus. So if you have $100,000 that gets allocated to 5-year property, you get to take that entire $100,000 year one. It's a fantastic tax attribute. But recapture means you have to recapture that depreciation you took. And so if you go ahead and you do a cost seg, you take $100,000 in depreciation via bonus, and you sell that building a year or two later, that bonus is going to come back to you at the same rate, 37%, as you got it when you took the deduction. You essentially got a deduction today and you paid it back 2 years later. So doing a cost seg, the benefit of it is dependent on how long you're going to hold the property for, because you want to try to avoid 1245 recapture because it comes back to you at ordinary income rates.
Correct. Yeah, that's what I tell a lot of my clients when I'm trying to put them in properties that net lease properties that have long term on them, because I know they're going to hold on to them for 10, 12, 15 years or more. And in that case, that's where the cost seg is beneficial, because they're not going to be selling it anytime soon.
Definitely makes the cost seg even better if you're going to be holding for a little while.
So what happens if an investor doesn't actually claim depreciation? First of all, have you seen that? And second of all, are they still liable?
These are the ouch situations. And oftentimes when I see it, it's because somebody else prepared the return and I'm coming in trying to fix it. So the IRS has a rule called allowed or allowable when it comes to depreciation. And what that essentially means is you get your basis in your building is lowered by the amount of depreciation you were allowed to take. It's not did you take it or not, it's were you allowed to take it. And if you don't take it, the IRS still takes the stance that you took it and you did not take the deduction, and they lower your basis on that asset. So you are subject to this recapture, this 25%, or maybe even worse if it's 1245, a 37% recapture rate, even though you never took the deduction. So it's imperative that when you're entitled to the depreciation, you actually take it, because you're going to have to recapture it whether you took it or not. It can be painful.
Yes. It actually amazes me that how often I come across a client, and without going into great detail, the CPA that they have is not a real estate savvy CPA. So that's one of the reasons why, Scott and I have collaborated a lot. We've shared the stage at different market events, and Scott and his company, they are a real estate savvy CPA firm. They deal with a lot of clients that are, high net worth individuals that have gotten to that high net worth by owning real estate. So for you, those investors out there that are watching this, it is key that your CPA is a real estate savvy CPA. I know I've told this to Scott before. I actually have CPAs that call me with questions. They've got, hey, this client's going to sell this building and we're not really sure about this or that. And I was like, holy smokes. I've actually advised clients, because as I've told clients, first person you should call as soon as you decide that you're going to sell an asset that you've owned for a long period of time, the very first call you should make is to your CPA.
We can't help if we don't know what's happening.
Right, exactly. And it's not uncommon for me to say, look, I need to refer you to a different CPA, because the information, the service you're getting right now could be better based on the fact that you've owned this. So next question. You had mentioned about how the IRS recognizes that. Is one of the ways they recognize that because when you file taxes and you have investment property, you're filing K-1s, right?
Either that, or if you own it outright, everyone's going to have it's going to have rental income, whether it be via K-1, via a Schedule E on your 1040, if you own the asset outright 100%. They're going to see the depreciation and the rental income. And they're essentially, if you get unlucky enough that they take a look at it, they're going to recompute it as if here's what your basis should be, here's what you sold it for, the difference is your gain. And whether or not you actually took that depreciation the year that you were supposed to, they're not going to look at that. They're just going to say, look, your gain is bigger now.
All right. So what's one piece of advice you'd give to someone selling a property with years of depreciation behind it?
Well, you already gave the best piece, which is call your CPA. But going further than that, there are tricks, there are strategies and things you can do planning-wise to help offset that gain. So before you sell a property, make sure you understand the depreciation elements of it. Make sure you understand what happens if you exchange and don't exchange, and just know what your options are. Information is power in this situation. So the one piece of advice I would give people is, if you have a lot of depreciation, you really should look into a 1031. That's a good idea, a good way to get rid of it. There's something called the buy, borrow, die strategy that real estate is so prevalent in. So understand your options, have a good account, have a good broker, make sure that you don't just think, oh, I'm stuck with this gain, or you forget that depreciation comes back at a different rate. Get a good team around you so you can make sure your options are all weighed equally.
Awesome. Scott, thank you very much. And where can viewers learn more about Ascend and how can they contact you?
Yeah, great. Website's a great place to learn a little bit about us. It's ascendadvisors.com. And my email is scott.gilmore, Gilmore, at ascendadvisors.com. I love real estate. Happy to help anybody I can. Just get them to the right place and build some wealth.
Awesome. Again, thank you for your time. I'm sure that you will be one of my regulars coming back to CPA Chat. And for the rest of you, be sure to like, subscribe, and make some comments. Scott will have access to the channel. We see comments. We'd love to be able to reply to your comments. Thanks for joining us, and we'll see you next time on CPA Chat.
Thanks, everyone.